Now onto Market Movers with easy-to-follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Urio, and today we're looking at the November 6 elections and how it could have an effect on gold. We're looking at using CME gold options, either hedge risk or create additional trade exposure. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, the dollar has liked so far what's been happening politically, what's been happening from a macroeconomic policy standpoint.
And volatility-wise.
And gold, with the strength of the dollar, gold has been pounded, right? So could this change the election? Could they think that our direction is not as clear?
They might. Now, the interesting comment you made was about gold being pounded. There's been days, Jim, especially early in the month, when gold actually rallied alongside the dollar, which was maybe more that freak-out trade. So, right. Yes, gold could probably getting back into its range of realizing that, yes, the elections are the thing that's weighing on maybe the precious metal.
Okay, so of the dollar, interest rates, or panic either existing or lacking, should have been panic over the last couple of weeks because there's been times I've been panicking in the stock market. What is gold trading on most of those three things?
If you're panicking, then I don't know what I'm going to be doing. Those are all good things. I think also inflation too, though, because now we're running up into a jobs number that's starting to maybe show some more hints of inflationary data coming through. That's another one I'd add to the bucket.
Love it, love it. Before we dive into our trade discussion, I'd like to point out, with all Market Movers trades, it's important to view these as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary in the market. When we price these out, the Dees gold contract was trading about $12.15. Scott.
Yeah, so gold's been an interesting trade or an interesting look in the last, say, 30 days, as you mentioned, alongside the ES volatility. And just the fact that, you know, gold to me has had a couple different stripes on it as far as in the last even couple weeks. And so what I did today, Jim, was I didn't go in with a bias as usual, and I feel like a broken record here, but just because I said, you know what, let me price out some different options levels and just see what they're costing these days, because that could kind of show you where the market thinks GC is going to go. And I think I found something kind of interesting out there that I'll tell you right now.
Waiting, right.
Which is, you're waiting, I know, bated breath here. So, Jim, specifically today, looking at buying the week 2 gold GC contract 1225, 1200 put spread for about 11 ticks. So you're going to risk about 1100 to put on this trade to make a potential 1400 if it fills out. Expires November 9th, as you mentioned. The underlying's about 1216, so it's already nicely in the money. And if you look back at the charts, my friend, of just the early, say, October moves, if you just draw kind of a line at the top of those highs, it's already kind of coming towards there, and I think it's likely going to fill out the bottom end of that put spread.
I like the price a lot. It's already got 9 or 10 ticks extrinsic in it. And it's that 1200 is the psychological level as well. So I like that a lot. It's not the way I am, but I think that's a solid trade. I'm looking at it a different way. I'm looking at buying the week 2, the same expiration, 1230, 1250 call spread for 3 ticks. It risks 300 to make 1700. So for you folks at home, this is obviously a much lower probability trade, and that's why the risk reward is so skewed. GCZ underlying, trading about 1216, we'll call it thoughts. You don't like the buy, you don't like the direction.
Well, here's what I do like about it. The risk reward's incredible.
Right.
So if you have something here that might go your way, which is one of these situations where maybe you put it on and then you just manage it, because it's not going to be hard to make a profit on this thing because of the low risk. Right. However, I do believe this is an ES that is starting to calm down. It's starting to maybe take its medication again. So it's calming down. It's starting to realize that maybe we can't have a buoyant market again. Therefore, I think gold's going to suffer in that environment.
Here's what I'm hedging against. Tell me if you like it or not. If the elections go the other way and we believe that the pro-business policies that have been going on the last 2 years are all of a sudden going to be sidetracked, then rates can't continue to go up. The Fed changes what they've been saying. Rates go lower. Gold then responds that way. Do you at least like that thesis?
That's a great point. Yeah, I like that thesis, and it's certainly a possibility these days, as we saw a couple of years ago and as we've seen over the last couple of years, and that's why gold would be a good thing to have.
Got it. Now, thanks for joining us on Market Movers. I'm Jim Urio, where we're hoping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.